Now, Drew Matus, Chief Market Strategist at MetLife Investment Management. You know, Drew, I have to start this off by reminding viewers that I do cover the retail sector. And so I think about the consumer an awful lot. And I have been really surprised, pleasantly, on how well the consumer has held up. I'll even go back 5 years, 2020. If you would have told me that we would have seen retail spending the way that we have over the last 5 years, knowing what happened in the broader world, I would have never believed you. But you're saying not the case anymore. You're seeing some cracking signs. Tell us what you're seeing.
Yeah, I think if you look at the New York Fed survey, which is one of the few data points we're still getting out, and you look at the breakdown by income, what you see is that the biggest deterioration in terms of people's expectations for their income minus inflation is coming from the extreme upper end of the income scale, right? So lower end consumers are actually, they're worsening. The middle is kind of holding in, but the real deterioration in terms of expectations is coming from the upper end. And now that might not translate into decreases in consumption for quite some time, but it's certainly going to get those people to maybe be doing things that are different than they had been in the past, maybe looking for deals where they hadn't in the past, and generally, adjusting their behavior in order to kind of compensate for the what they perceive as a potentially higher risk of being laid off in the future, which is something else we're seeing in the data.
I don't disagree with you with what the data is telling us and then what that should portend for what happens. But I've been wrong for a while now. And the data sort of shows, particularly the softer data, the sentiment. We're not seeing that follow through when it comes to spending. Consumers are still spending. And so if I can just push back for a minute, the higher end for some time has really been pulling the train for consumer spending. And the lower end, I mean, aren't they always a little stressed? If the Fed isn't worried about the rate of inflation and they're not seeing a strain on the consumer, why then do you think it's happening now with the lower end? And why do you think that upper end is starting to feel more strained? I'm still just not quite understanding how that's happening when I've been wrong before.
Certainly. Well, look, I'm an economist, so I've been wrong a lot in my life. In fact, I made my living off of it. I think if you look at consumption data that we have right now, obviously the government stopped producing some of this data, but the most recent data we had really had begun to show a downtrend in spending on services. And my first boss on Wall Street, genius at reading the consumer, used to say that if someone's worried about buying a cup of coffee in the morning, they're not going to buy a car in the afternoon. And we're beginning to see that pattern emerge where spending on services is drifting below a trend-like level. Spending on services tends to be consistent. It's you stopping off to get your cup of coffee in the morning. It's you going to your doctor's appointment. It's you getting your hair cut. These are patterns that really shouldn't change all that much month to month, and we're beginning to see that drift lower. What that usually means is that people are beginning to cut back on things or do things differently. And when people behave differently, it's not usually for a good reason. I think that when you look at sentiment, the sentiment is way too low than where it should be relative to unemployment and the like. But these patterns are emerging where consumers are beginning to act more cautiously. And it's going to take a while for that to show up because upper income people have the means to keep spending for a while, but that doesn't mean they're not noticing these things. And I think that's the key difference now is we're seeing evidence that they are noticing these things and actually beginning to take some actions.
That is interesting. And of course, this time of year is really important for consumer spending as we're looking at the last couple of months. And of course, we have the holiday season. If consumer discretionary then is probably not where you want to put your money based on the thesis that you're putting forward, where is a place that we should be investing? Or because consumer spending drives so much of economic activity, does it sort of feel like maybe you're less bullish overall going into the end of the year? What's your advice for investors?
Well, probably less bullish is a good way of looking at it, but I would also think about this. Just because someone's having trouble making a purchase now doesn't mean that they're going to have trouble paying for what they've already bought, right? And so I think, if you think about where you can take advantage of an improvement in the economy or deterioration in the economy, right? If the Fed's cutting interest rates, who benefits from that? Well, typically financials benefit from a steepening yield curve. Typically financials benefit from volatility. So it's a way of saying that if I'm wrong on the consumer and there's more volatility around the numbers, then we could see financials benefit. And if I'm right and the consumers begin to fall apart and the Fed cuts interest rates aggressively, then you'll see the yield curve steepen, and banks should also take advantage of that. So it's kind of a nice way to hedge. If you look at other places, there are places you probably want to avoid. I think housing is a great example. Housing prices are not likely to collapse anytime soon. And people talk about a housing shortage, but at the same point, I'm not seeing a lot of buying out there. And so that's, a place to be a little more cautious.
It's very interesting when you talk about financials. I feel like earlier this year, financials was sort of a sector that so many looked at and said, this is going to be the one that's going to take off. With the change of administration, the expectations that regulations were going to pull back. And you didn't mention that in your thesis. I suppose if there are some big regulations that pull back, maybe more deals start to happen, then that could further sort of push the financial group higher? Or is that sort of financials are your pick no matter if that happens or not?
It's really immaterial. It's more just how they respond to the consumer and some of the natural hedge that it provides. If the economy,
okay, got it. Well, that makes sense. Go ahead.
And the economy is really weak, then everyone's going to have difficulty, right? But it's a matter of, does it create more volatility in markets? If so, good for them. If consumers are still able to pay for things that they purchased, good for them. And if the economy takes off, good for them. It doesn't mean there aren't scenarios out there where things can fall apart. But at the same point, a large majority of the scenarios lead to kind of decent outcomes there.
Huh. Very interesting. Of course, it has underperformed quarter to date on a percentage basis. So maybe there is some room to run there. Drew Matus with MetLife Investment Management. Thank you for joining us.